Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Bank of Nova Scotia topped estimates on better than expected results in the first quarter at its Canadian banking division. The bank saw earnings growth across all divisions, including domestic banking, wealth management, capital markets, and international divisions. So, Toronto-based company has been slashing expenses to improve operations and says earnings growth should accelerate in 26. FedEx has filed a lawsuit in a U.S. court seeking a refund for U.S. President Donald Trump's emergency tariffs. The transportation company did not provide the dollar value. Club retailer Costco and cosmetics firm Revlon also some of the companies in tariff refund cases, more than $175 billion U.S., are subject to potential refunds after the U.S. Supreme Court overruled Trump's tariffs on Friday. Shares of AMD are climbing today. They're up more than 6%, 6.7%. Meta announcing it will buy AMD chips and computers designed to run artificial intelligence models over a 5-year stretch beginning in the second half of 26. According to the chip maker, transactions will be worth double-digit billions. As part of the arrangement, Meta will receive warrants to buy 160 million AMD shares. Last week, NVIDIA disclosed a similar tie-up with Meta. Taking a look at the markets, and everybody's in the green right now. The TSX back on the plus side, pushing into record territory again today. South of the border, also a lot of green down there. After the tariff scare yesterday, they're recovering some of that back today. S&P 500 up 0.55, the Dow 0.73, and the NASDAQ is up 5.92. Okay, for more on the Scotia Bank results, we are joined by Christine Dobby of Bloomberg News. Christine, thanks as always for joining us.
Yeah, nice to see you, Roger.
All right, so an earnings beat for Scotia. Where were the strengths?
I think, as you mentioned off the top of the hour here, the interesting thing was they had good results across all of their divisions. They beat expectations in Canadian banking, as well as capital markets and wealth management, and in their international division, which they have been really working on turning around. This was an area where they saw the completion of a transaction to divest of their Colombian assets that closed during the quarter. So that was interesting to see. But yeah, when you listen to the earnings call, there was really a sense of optimism from CEO Scott Thompson that this is the result of the long-term plan that they put in place to turn things around, and it's starting to pay off. They're talking about meeting their return on equity targets a year ahead of schedule, even.
So it sounds like they're getting a lot of things right. What have they changed that to turn it around like that?
So in their Canadian banking business, which has been a real focus of where they've been really looking to improve, it's been a bit of a story about optimization or rejigging to focus on this idea of primary clients. That is, clients who use Scotia Bank across a range of their products. So they haven't really returned to loan growth in that area. They're more focused on getting these clients who bank with them across all these different areas. And they've also done cost cutting to improve efficiency there. They took out a lot of costs last quarter, which did involve a number of job cuts.
Okay, and risk for investors, concerns they should be keeping an eye on?
Yeah, so the other interesting thing on the call today was they did get a lot of questions about credit and their provisions for credit losses, potentially bad loans, did come in a bit higher than analysts had forecast. They reiterated that they think that impaired loan loss provisions will remain pretty elevated for the first half of the year and likely come down in the second half. But that is contingent on the broader economic picture, which, as we know, can change at any time. And one area that they talked a bit about on the call on several occasions was mortgages that had been taken out during the pandemic era. As you'll recall, home prices were very high at the time and interest rates were very low, and that has basically flipped on its head since then. So some of those mortgages in the GTA in Ontario are experiencing a bit of stress.
Okay, we'll leave it there. Christine, thanks as always for joining us. Christine Dobby of Bloomberg News. Yeah. Coming up, we'll get an investor perspective on the Scotia Bank results with Benjamin Klein, portfolio manager at Baskin Wealth. Shares of Scotia Bank are up slightly after the company posted better than expected results at its Canadian banking division. The company posted a profit of $2.29 billion in its most recent quarter and saw earnings growth in all divisions, including domestic banking, wealth management, and capital markets. Our next guest says Canadian banking is stable and has good margins and cost controls. Let's get more now from Benjamin Klein, senior portfolio manager at Baskin Wealth Management. Benjamin, thanks as always for joining us.
Thanks for having me.
Okay, just a quick report card on Scotia. What'd you like about it? What concerns?
Nothing to us too surprising about the earnings. They seemed relatively stable. Now that Canadian banking has such a heavy emphasis on capital markets and wealth management, there's often going to be a pretty high correlation outside of unusual extraneous circumstances. There's going to be a lot of correlation with how the stock markets and capital markets are doing. Obviously, the capital markets, particularly the TSX, have been very, very strong, and that's a big reason why the banks, of course, did so well last year and so far this year. And why they're seeing an increase in their earnings basically across the portfolio. One interesting thing we did see is a modest uptick in delinquency on auto loans and credit cards. Hard to tell without looking a little bit more deeply what potential impact that might have, but we're interested to look into their mortgage renewal commentary to get a little bit more color on that.
And what are you expecting from the mortgage renewal commentary?
So it's hard to say. 2026 is kind of the final year of the 5-year mortgage renewal cycle. Investors or house owners rather that signed on to mortgages in 2021 at much lower interest rates. This is now the last year of those mortgage rates being renewed into much higher rates. So this should be a tailwind for the banking sector overall going forward. To us, the biggest takeaway here from the Canadian banking sector is Canadian banks lend almost exclusively to prime borrowers. So the impact has so far at least been much more significantly on subprime and alternative lenders. So we don't expect to see a huge impact on bank mortgage portfolios, but it'll be interesting to take a look at.
And just going back, you mentioned a lot of the money coming from the TSX having a banner year. Any concerns about that as a source of income?
It depends what you're looking for, of course. The banks to some degree are becoming maybe more dependent on the stock market, and the TSX having such an incredible year, and you can talk about second order effects. Gold having an unbelievably good year, and that propelling the TSX, and to some extent, your outlook rather on Canadian banks depends on how resources and the rest of the TSX are going to do. I think that's a different conversation, but our expectation is this year is not going to be quite as incredible as 2025 was.
And can we read into this as being an indicator for the other banks when their earnings come up, or is it really case by case?
Very likely. I mean, it's unusual outside of, say, the TD AML issue. It's very unusual that you see, one bank or a couple banks diverging substantially from the other banks. So we would be surprised to see, the other banks have very different earnings reports. But, they all do have their differences. And so, the differences between them and their strengths and weaknesses, always worth looking at.
And I imagine that same concern, you'll be looking at credit card auto delinquency, that area there for all the other banks when they come out?
Yeah, again, without having dug quite so deeply, given the earnings just came out this morning, it'll be interesting to see, is this a blip? Does this project something going forward in the future? But certainly something to take a look at.
And moving forward, what are we looking at for 2026 for the banks?
So again, one major factor for them is the mortgage renewals happening over the course of the year and going forward. This should be a tailwind for the sector moving forward from here, given rates are being much higher. Net interest margins. So, for example, our clients own shares of Royal Bank and National Bank. We think they have the best checking, and in addition to TD, have the best checking deposit system, which of course gives you the best spread on paying interest to your clients versus investing it yourself. And again, earnings have been highly correlated to the capital markets. The capital markets have been extremely strong. I think reasonable to expect things won't be quite as rosy going forward, particularly given that bank valuations have been driven up as a result of that strong stock performance, and they're trading at about 2 times book value now. And again, we prefer the banks with the strong deposit bases, particularly Royal and TD, and strong wealth and capital markets experience, and also the strong capital allocators, the strong management. So that's why National Bank has been a core holding for us for years.
And any concerns with a lot of mortgages coming up? The rates have come down, but people are still probably renewing at a fairly noticeably higher rate than what they got in 2021. Any concerns about defaults and people bailing?
Concerns for sure, less so on banks, because again, the banks lend almost exclusively to prime borrowers. They should be the least risky, but absolutely, we are seeing impacts on alternative and subprime lenders, and if that continues to get worse, of course, you could see some impact on banks, but we would be surprised to see a major impact. All
right, and just one last bigger picture question: tariffs, the trade deal. How does that factor in with everything?
I think, of course, the only reasonable answer is nobody knows, because that's the case.
That's a good answer.
That said, if history is anything to go by, which I hope it is, we know that the U.S. market is dependent to a significant degree on Canadian exports, and I think if there was anywhere to put your money on, it would be that there will be a deal reached, and it probably won't be all that different from what we've seen in the past, but obviously a wild card, and I think impossible to tell with any degree of precision.
All right, we'll leave it on that note there. Benjamin, thanks very much for joining us.
Thanks for having me, as always.
Benjamin Klein, Senior Portfolio Manager at Baskin Wealth Management. Home Depot shares are moving higher after a fourth quarter earnings beat, and we'll take a closer look after the break. Nations across the globe are pushing back against U.S. President Donald Trump's latest tariff threat. CTV's Judy Trin reports.
My fellow Americans, this is Liberation Day.
Donald Trump's use of emergency economic powers to impose tariffs has been shackled by the Supreme Court, but the White House says it will use other tools to get what it wants.
We had to look at backup plans, and we found ways to really reconstruct what we're doing. Now it doesn't have the same flexibility.
Trump says he'll now impose new 15% global tariffs to replace the ones deemed illegal. He warned against playing games and threatened much higher tariffs if countries back out of trade agreements. In the past year, the U.S. took in more than 240 billion Canadian dollars in duties.
He needs to return that money, needs to refund that money with interest. He can do that in a nanosecond.
Lower courts will decide if refunds are needed. Amid the uncertainty, the European Union is pausing ratification of its deal with the U.S.
We are trying to maintain predictability for businesses, for consumers, in the face of some substantial unpredictability.
The Supreme Court decision won't apply to tariffs that are devastating Canadian steel, aluminum, automobiles, and softwood lumber. Earlier this month, some Republicans joined Democrats to vote against Trump's tariffs on Canada. Ontario's premier emphasized the president's weakening support.
We saw what happened in Congress. We saw what happened in the Supreme Court. The walls are closing in, I believe, on President Trump right now.
Protected under CUSMA, most Canadian companies will be exempt from Trump's new tariffs. The Prime Minister has yet to comment on the president's new threats, but Mark Carney is preparing for an overseas trip. He's heading to India, Australia, and Japan later this week to increase trade with those nations.
That was CTV's Judy Trin reporting. Well, Home Depot shares are rising after reporting fourth quarter earnings that beat estimates for the first time in a year. Joining us now for analysis is David Bellinger, Director and Senior Equity Analyst at Mizuho. And David, thanks very much for joining us.
Thanks for having me on.
There we go. You're there good, David. I thought we lost you for a second. Overall, what do you think of the report? Oh, I think we are having some technical difficulties. David? Okay, we're having some technical difficulties with David Bellinger at Mizuho. We will get back to him when we can. We'll have more coming up after the break. Shares of Thomson Reuters are soaring today. The content and technology company says it reached 1 million professional users on its legal and business AI tool, and it's working with Anthropic's Claude model. The Toronto-based company also mentioned it was working with OpenAI's GPT and Google's Gemini. This is Reuters' biggest intraday gain since October 2008. Canada's aviation regulator has certified the remaining Gulfstream private jet models. U.S. President Donald Trump had said earlier that Ottawa had declined to approve the jets and warned of tariffs and other retaliatory measures. Transport Canada has now approved Gulfstream's G700, G800 models. Last week, the regulator approved two other models mentioned by Trump. Bloomberg News is reporting Canadian generic drug manufacturer Apotex is looking at the first half of the year for an initial public offering. It could raise as much as $1 billion. An IPO of that size would be Canada's largest debut since 21. The report says no final decisions have been made on the exact timing or size of the offering, and plans may still change. Apotex was founded by the late Canadian businessman Barry Sherman. And taking a look at the markets, the TSX back into the green. After a little bit of a slow day yesterday, it's up well over 33,000, pushing 34,000, up by 0.16 for today. South of the border, bounce back there after that rough day for them. You can see S&P 500 up by 0.57, the Dow up by 0.77, and the NASDAQ by 0.91. As we talked about, Home Depot's shares are rising after reporting fourth quarter earnings that beat estimates for the first time in a year. Joining us now for analysis is David Bellinger, Director and Senior Equity Analyst at Mizuho. And David, thanks again for joining us. We'll get to it now. Initial reaction to the report.
Hey, great. Thanks for having me on. This was a good, not great quarter from Home Depot. You had same-store sales in the U.S. They were up fractionally, about 0.3 percentage points, so not all that much, but you did have very low expectations, very subdued expectations into the print. We were looking for a negative number, much of the street was, but what you can see here is that there are some signs of life in the home improvement market. It's been more stable than anything. You've had a lot of winter weather activity throughout the eastern seaboard of the U.S., even the southern U.S., mid to late January. So that perked sales up a bit here, but it's almost as if the demand environment has been stable and that there's a case for gradual improvement as 2026 progresses. And I think that's why I'd get the stock up a little more than 3% today.
And what's that case? What's giving you some optimism, shall we say?
Yeah, you've got the biggest piece here is just this digestion period from the peak stimulus era spending. Think about 2021, a lot of money sloshing around in the U.S. A lot of that went to the housing sector, the home improvement sector. So now you're getting to this sort of refresh cycle. We think a lot of that digestion is about to bleed through. And then you have the Trump administration that is very focused on getting the housing market back going again, stoking the housing market in some way. You've got talks about 50-year mortgages, building 1 million new homes. You also have rates coming down. You have a new Fed chair coming in very soon. You see mortgage rates going a tick under 6%. Not a magic number that helps the existing home sales number pick up, but anything with a 5 handle on it in that 5% range should definitely help. But you do have an administration that knows the importance of housing and all the add-on spend that comes after, right? We're furnishing a home, fixing it up, maybe you buy a vehicle, you have kids, and really opens this gateway to spending. And I think they've got that in mind.
And any potential headwinds with that? I mean, there is some reason for optimism. What could be potential headwinds?
Yeah, I mean, the bigger conversation, but the market is incredibly edgy towards anything AI related. So how does AI affect the broader economy? Are we going to see job losses, income levels go down? Like, how does this affect the housing market, which is already somewhat unaffordable in the U.S.? So a lot of cross currents here. We think Home Depot does have this steady demand. You've got, even if homes aren't turning, you've got a lot of maintenance activity, right? So a lot of business lines that keep the lights on for Home Depot. And then they've also got some agentic shopping going on. They've got an agent called Magic Apron within their app and their site. We think that's driving a lot more research taking place on the Home Depot's digital properties. You get better conversion. Maybe you do spur a little more of these do-it-yourself type projects. So I think they're moving in the right direction amid this stable demand environment.
And with this report and what they're projecting for the year, does it change anything about the 12 stores they plan to open? Or 15, sorry, really. 15 stores they plan to open. They opened 12 in 2025.
Yeah, exactly. You've got 15 new stores coming along. Home Depot's also made a few of these larger scale complex pro acquisitions. You might have 50 new stores from that subset. But that's been a part of the Home Depot story that's been pretty much overlooked, I think, here. You've got 2,000 plus stores in the U.S. They haven't grown all that many lately, but you are on this 5-year pace to grow about 80 stores. That could add a little more growth to the business, but they're all about productivity. That's been the big hallmark of the Home Depot story. Each and every unit continues to drive higher and higher sales productivity, and that's where you're seeing a lot of the earnings growth come for HD.
And then I guess, and then the last question, tariffs, what's been going on the last couple of days, what may unfold with CUSMA, all of that, what kind of an impact is that having, or have they adjusted to it?
Yeah, a lot of moving pieces, right? Yeah. So you've got the IEEPA tariffs going away. They've been quickly replaced. Home Depot does source more than half of their goods from inside the U.S. You've got exposure elsewhere, though, right? Even Canadian softwood lumber, you've got tariffs on that. Those have picked up. So it's a slippery slope of trying to navigate and thread this needle on tariffs without taking too much price. And I think they've handled it pretty well so far. Just on their earnings call a little while ago, they were talking about most of the tariff pricing going through, and they're seeing inflation on like-for-like items of around only 3%. So they've managed that very well. They've got great visibility onto what their fully baked product cost is the day it hits in the U.S. I don't think a ton of retailers have that visibility, and that's helping them to ease this price burden a bit.
Okay, we have to wrap it up there, but David, thanks as always for joining us.
Great, thank you.
David Bellinger is Director and Senior Equity Analyst at Mizuho. Well, the Bank of Nova Scotia, we've been talking about top profit estimates in its latest quarter on better than expected results in its Canadian banking division. For more, we sat down with Colin Chizinski, Chief Market Strategist at SIA Wealth Management.
Very positive and a great kickoff to earnings week for Canadian banks. They didn't just beat by a little; they beat by quite a bit. So that's very, very, very encouraging. And two things that are important here is number one is strengthen the Canadian market, even under the threat of tariffs and uncertainty and everything else. The bank results are telling us that the Canadian economy is holding up really well. The other piece of this was international, that they noted their international growth is really coming in as well. The relative strength analysis that we've been doing among asset classes tells us that international has been strongest, Canadian has been second strongest, and U.S. has been third strongest among the equity asset classes. So this is these results are reinforcing what we're seeing in our analysis of capital flows as well. So this is it's a really good report and a really good start to earnings season. One other thing that was of interest was they only raised their loan loss provisions marginally, like 14 million on $1 billion. So it's very, very small. So that's also a positive sign as well that things are steady as she goes at the moment.
All right. Just looking at some of the numbers here, global wealth management up 18% year over year, and the international banking segment up 10%. Those are pretty impressive numbers.
Absolutely, and is showing really good, strong growth. The wealth management is to somewhat be expected given how well global equity markets have done since April of last year, and they're clearly benefiting from that, and clearly benefiting from that kind of growth. But international as well, and it's really important for us to note that as we're seeing strength in the economy, it's not just the U.S. Canada has been holding up well, but international growth has been very, very strong, and that's really important as we move forward and we look at how we look at equities and far beyond just the banks.
And then with the credit losses, an increase, but not, I think it was an increase. I'm just trying to look at the numbers quickly here. Anything worrisome about that, or kind of in line?
No, it's in line for me. And what's important to me about that is that it was a very, very small increase, just marginal, really. I mean, for a bank, it's almost a rounding error. And so really it's quite encouraging. It suggests that things at this point are stable, and stable is good.
And can we use this as a bellwether for the rest of the banks, or too soon to tell?
The biggest thing, one of the biggest differences with the rest of the banks we'll see is that Scotia is more international. The other banks have more U.S. operations than Bank of Nova Scotia does. So that's where we might see the biggest difference is between what happens between international and the United States. The Canadian business Scotia strength for Scotia is a good sign for everybody. So that's good news. In terms of wealth management and capital markets, that's good news. We know the markets have been doing well, so that's generally should be supportive for everyone. And then we'll see what's happening with the U.S. banking. That's the most significant difference, and we'll see that play out over the next couple of days.
And are the tariffs having any impact on the banks, or what kind of an impact are they having?
It's hard to say. I mean, the important thing for the banks is that the economy is doing reasonably well. Loan loss provisions would suggest that holding stable would suggest that, at least to this point, whatever impact there has been has probably already been factored in and kind of worked into the system. So I think the big thing would be is if there was a significant change going forward. But at least for now, it seems to be somewhat in balance. And then for the other banks, I know they do have significant operations in the United States already that would not be affected by tariffs in any way.
Okay, and market reaction to this report? I mean, it seems good. Is it going to be good enough?
So far, so good. It's the bank shares were holding steady in pre-market trading. So far, so good.
All right, and we've got a lot coming up for this week. It's going to be a busy week. What other banks will you be keeping a close? Is there one you'll be keeping a closer eye on than others?
None in particular. They all come out so quickly that it's we just kind of look at everybody as they come. And what's important with that is that it gives us the ability to readily compare everybody's results too, because they all come out over a 3-day period. It really gives us an idea very quickly to establish what trends are happening.
And that was Colin Chazinski, Chief Market Strategist at SIA Wealth Management. Coming up, what does Trump's double down on tariffs mean for the Canadian economy? Our next guest will break it all down. As the dust settles around President Trump's new global tariffs, many countries are scrambling to figure out how the move will affect them. With Canada already a frequent tariff target for the president, the new policy could be yet another blow to the trade relationship. But in what way? Let's get some perspective from Julian Karagassian. He's a lecturer in the Department of Economics at McGill University. And Julian, thank you very much for joining us.
Thank you for having me, Roger.
Where does this latest, the ruling by the Supreme Court and Trump's reaction, where does this leave Canada?
Well, directly, in terms of direct impact, not a lot has changed. The sectoral tariffs on aluminum, on steel, on automobiles, on lumber, on wood products, those remain in place. But the upside of that pre-change in Supreme Court ruling, 90% of goods have been crossing the border over the past year, tariff-free, because they're covered by CUSMA. And that became quite clear last April. So 90% of the goods will continue, unless something else changes this week, 90% of goods shipped from Canada to the United States will continue to be exempt under CUSMA. So nothing really materially changes. Unfortunately, the sectoral tariffs remain in place.
And obviously, and that's the big concern. Just a quick question. You say 90%. Have more companies managed to find more things to qualify under CUSMA? Because I for some reason, I'm thinking of 86, like it was about 86. So people actually tried to step up and get more things to qualify?
It was, yes, or companies have just got their documentation ready for the U.S. Customs and Border Protection. So a lot of it had to do with documentation or the way that products were defined, because before, the free trade platform provided a lot of tariff-free access, and now a lot of documents are required. So companies have got up to speed on that.
And now with those sectoral tariffs that were being hit with steel, aluminum, could those face any challenges in court, like we saw with the Supreme Court ruling?
Well, they could, because the Supreme Court ruling was interesting. The House of Representatives and Congress generally is the body, is the part of government, the branch of the U.S. government that's responsible for raising revenues. So any revenue-raising measure actually has to start in the House of Representatives. And the Supreme Court ruling last week affirmed that you can't put tariffs on to raise revenues. You can't regulate commerce with revenues. You have to use other measures. And so these sectoral tariffs that we face, the 25% on automobiles, the 50% on steel and aluminum, those are under Section 232 of U.S. trade law. And that part of the law invokes a threat to national security from importations from certain industries like automobiles or steel, or certain products. And so that has been invoked against us and against other countries. And the question is, do Canadian exports of, for example, aluminum threaten U.S. national security from an economic point of view? I'd say that that's something that can be very easily challenged in the Supreme Court if it were to be taken up there, because the United States doesn't produce a lot of aluminum. Canada is a larger producer than the United States.
Now, could you see that being challenged, or at least, and would the Canadians just want to kind of sit right now and figure out how to negotiate CUSMA with this latest Donald Trump?
I mean, Prime Minister Carney is a very strategic person. He's also very tactical. I don't think he would want to take that up now as head of the government of Canada while we're negotiating CUSMA, as you just suggested. If the CUSMA negotiations become extremely difficult or protracted, or if we have to walk away, if the Trump side demands too many concessions, then we could take that up with the U.S. Supreme Court. And it's interesting, last week's ruling, the court case was brought by 12 U.S. states, many of them Republican, and U.S. business. Many U.S. businesses brought that case.
And then bigger picture, I mean, we've been trying to get away. The government has been trying to move Canada away from the U.S. as a trading partner. Yeah. Is that working? And will any of this have an impact, do you think, on those CUSMA negotiations?
Well, I think it's working in the sense that, it's, at the end of the day, it's people, businesses, and markets that conduct most trade. And the path of least resistance for Canada has been to trade mostly with the United States because of geography and language and so forth. So now we're having to make this extra effort to diversify our export markets. And before that happens, we have to lay the diplomatic and geopolitical foundations for that. And the Prime Minister has done that with the People's Republic of China. The conditions have been laid for a wider engagement. They called it a strategic partnership. And now with Mexico, with that immense delegation that the government of Canada went down with last week, including a provincial premier, we're laying the diplomatic foundations for a broadening of the relationship. Could that affect CUSMA? It could. It could make President Trump and his associates double down and say, you're not going to have these bilateral trade engagements, without our permission. But I think that we have to do that. It's in our long-term interest to spread our economic eggs in many baskets.
Okay.
And I don't see the U.S. trade uncertainty going away anytime soon.
All right, we have to wrap it up there, but Julian, thank you very much for joining us.
Thank you for having me, Roger.
Julian Karagassian is a lecturer in the Department of Economics at McGill University. Coming up, more reaction to Scotia Bank's latest earnings report and thoughts on investing in Canada. That's after the break. Loblaw will invest $2.4 billion in 2026 with plans to build 70 locations and create more than 9,000 jobs across Canada. CTV's Adrian Gobriel has this report.
With Canada now home to the highest rate of food inflation among the G7, one of the country's largest grocers is setting the table for a sizable expansion.
It says we're here, we're optimistic, we want to continue to grow.
Loblaw Canada is investing $2.4 billion in 2026 with plans to build 70 new locations and create more than 9,000 jobs. The National Grocers Plan will focus on building new Shoppers Drug Marts, No Frills, and Maxis for budget-focused customers.
I think it's definitely a sign of the times.
Loblaw says it plans to open 4 new stores in Atlantic Canada, creating 600 jobs. 15 new locations in Quebec will create more than 1,985 positions. Ontario will receive the largest boost with 27 new stores and 3,775 additional jobs. Provinces to the west will welcome 24 locations, creating more than 3,400 roles with the company. Food economists say grocers are taking notice of cost-conscious consumers.
Grocers focus on 2 things. The first is share, that is getting people to walk into your store. And the second is basket, which is how much they spend when they come in. And if either of those goes down, they feel the pinch.
A statement from Loblaw in part says that opening new stores and pharmacies, especially in underserved areas, will help make value and healthcare more accessible.
They're not leading consumers, they're responding to changes in consumer buying habits.
Loblaw's push to expand its discount options is part of the company's 5-year plan to spend $10 billion by 2030.
Some economists expect the company's upgrades to look similar to this. Just 2 years ago, this was a Loblaw's. It's since been rebranded and retrofitted as a No Frills, a sign of a shifting marketplace. Adrian Gobriel, CTV News, Toronto.
And we continue our coverage on bank earnings season after Scotia Bank beat estimates in its first quarter. For more on this and some other ideas for your portfolio, we sat down with Brian Belsky, CEO and Chief Investment Officer of Humulus Investment Strategies.
Well, I think, the big 6 banks have done a wonderful job in terms of managing their capital. We've said for years and years that Canadian banks are the most excellent stewards of capital in the world. And, last year, meaning 2025, was a year where the banks were starting to use off of the excess reserves that they were really building through much of 23 and 24. And so the benefits of that are really even following through into this first fiscal quarter for 2026 for the banks. We worry that the Canadian economy might be slowing a little bit faster than the U.S. economy. We worry that Canadian banks in general have had such great performance from a fundamental perspective that they've spent a lot of money with respect to divisions as well. But Scotia in particular is going to follow and set the trend for what we believe we're going to see for the rest of the banks, meaning good capital markets perspective and volumes during the quarter because of the volatility. Wealth management, especially at Scotia, they've kind of righted some of the branding ships and some of the issues that they've had there. So I do think that Scotia's kind of setting the pace in terms of some of the other banks. But by and large, the banks in general, we think in our view at Humulus is that the banks are going to be much more selective versus last year. They all kind of went up in unison. So you're going to have to increase your stock picking chores within the big six banks.
So, but Scotiabank would be one of the bank stocks you favor, Brian?
Well, we own Scotiabank in one of the 8 model portfolios that we run for clients, both Canada and the United States. We own it in our North American dividend growth portfolio. This is a company that has consistently raised its dividend over time and has great free cash flow yields above the dividend yield with respect to being more tactically positioned in National. I think there's other banks like RBC and National that we would prefer with respect to tactically over the next 12 to 18 months.
Royal Bank and National. What would appeal to you with National? I mean, they have been growing rapidly. They just pulled off a big acquisition. Is that part of it as they squeeze profits out of that?
Well, I think number one, management. Their management has been in place for a while, especially relative to some of the other big banks. And number two, they pulled off a great acquisition out west. And as you know, the West is growing from a population perspective and a GDP perspective a little bit more consistent than what we've seen in the East. And number three, from just a pure growth perspective and how they manage their individual divisions, we have a lot of confidence in.
What about the big U.S. banks? Are they drawing your attention at all, Brian, the JP Morgans and the Bank of Americas?
Yeah, Jamie Dimon, once again, sets up for everybody to be worried. You know, he likes to underpromise and overdeliver. And, you know, he puts his money where his mouth is. Remember, he was one of the CEOs that still remained from the credit crisis. And he's been making comments with respect to what's been going on in terms of private credit, but then also AI. Two of the things that most investors are worried about with respect to financials. We still love financials in the United States from a thematic perspective, Andrew. And the themes are kind of a big barbell. On one side, we like the big banks with respect to the scalability of JP Morgan, Citigroup, Bank of America, especially Bank of America in terms of their Merrill Lynch division. And then we like the really small banks because of the relationships that they're able to maintain with respect to growing the commercial banking side and the individual banking side. So the in-between banks, quite frankly, more of the super regionals are the ones that we more worry about because we do think they can't compete with the small and they can't compete with the big. So I think the banks that you just had up there, including Wells Fargo, I think from over the next 12 months are where you want to be, especially as I think a lot of people are forgetting that regulations are going to go down in the big banks and the funding mechanism, we think, as interest rates continue to go down as well, that affordability is going to get better. And we're going to have another real estate increase in terms of real estate prices continuing to go up.
Brian, what about Home Depot? You say investors should watch out for misleading signals here?
Yes. Now, Home Depot is a bellwether retail stock. Now, remember, in the fourth quarter, people spend their money in the United States a little bit differently than they do the rest of the year. Last year in 2024, we had an additional fiscal week as well for the fiscal year. So that was what the numbers are a little squishy. If you look at continuing operations earnings on Home Depot, they beat the number. Home Depot is about the consistency in earnings, Andrew. It's not about this go growth side of things. And especially given the fact that consumer sentiment has been weaker, Home Depot's an area where it's more actually of a consumer staples retailer. And we've owned it for several years in the portfolios that we've been able to run. And so Home Depot, we think, is one of those names that you want to own in a market like this.
What about the U.S. consumer, Brian? We've heard endlessly about the so-called K-shaped economy, the lower-income people struggling. Any thoughts on that? I mean, are you avoiding companies that tend to be more dependent on lower-income people's spending habits?
No, because if you take a look at where, let's say, where Walmart has done the last, let's say, 12 to 24 months, low income to medium-sized income are still spending their money at Costco. Costco, we believe, is a top 25 company in the world. And then if you also take a look at where Amazon in the price differential and the price breaks that they're giving investors, Amazon underperformed last year. And a lot of people missed that. I think the consumer discretionary sector last year had a much more volatile time. Remember, Tesla is part of the consumer discretionary sector, so that's what really drove that sector higher, where Amazon had more issues. And Amazon was really beaten down from the AMS division, not so much with respect to what's going on with the consumer. So from the pricing side of things, investors in the United States especially are much more price conscious. They're smart about how they're going to buy things and buy things in volume. And I think that's why the Costcos, the Walmarts, and the Amazons from us still make a lot of sense.
That was Brian Belsky, CEO and Chief Investment Officer at Humulus Investment Strategies. Now, Your Options is back. Tune in Wednesday at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. You can send us your questions at knowyouroptions@bnnbloomberg.ca. Market calls coming up next. Today on the show, we have Ernest Wong. He is the head of research at Baskin Wealth Management. He'll be taking your questions on North American Large. Now, let's take a look at how the markets on Bay Street and Wall Street are trading right now. First up, the TSX. It's just about a wash for the day right now, up by 0.02%. Still well above 33,000, still pushing towards that 34,000 mark. Leading the way, Thomson Reuters. Let's take a look and see how it's doing. It's having one of its best days after hitting a milestone of 1 million professionals choosing CoCounsel, the company's professional-grade AI technology. You can see it's up more than 12%, making it for one of its best days in a long time. And for the month, though, you can still see it's been struggling. It's off by 26%. Now, going the other way just quickly, Winpac announced their earnings yesterday, and it was a miss. And today they're paying the price. They're off by about 4%, leading the downside on the TSX. The revenue declined by 0.3 million, and they were off on their shares down to 60 cents per share. Heading over to Wall Street, quick look there. Everybody in the green right now. S&P 500 up by 0.62, Dow by 0.69, and the NASDAQ by nearly a point. That is it for Morning Markets. Thank you for joining us. We'll see you back here tomorrow. Have a great afternoon.